Hi, I'm Jeff Bermet, and along with Nick Davis, we are the co-managers of the Libero Nexus Cautious, Dynamic, and Solutions portfolios. Wars in the Mideast are always the transmission mechanism into what it does to the world economy is always through oil prices and energy prices. And in this case, it's oil and natural gas prices. And we've jumped, remember, as late as December, oil was $60 to $65 a barrel. There was a feeling there was a glut of oil supplies and that OPEC was holding back on production to try to keep those prices from falling further. Now, as I speak to you, oil's in the low 80s, like $82, $83 a barrel. And it's all about not that Iranian oil is disappearing from the markets. The 1.5 million barrels that Iran was producing was all going to China anyway at a massive discount. So the world wasn't accessing that oil. It's all about, can Iran so disrupt the Straits of Hormuz, where about a fifth of the world's crude oil and natural gas flows through to get to Asia and Europe. The shipping industry has responded very quickly by telling their captains, don't put your vessels in the Straits of Hormuz. So effectively, no oil is coming out of there. Trump announced an effort by the US government and the US Navy. The Navy will help escort ships through the straits to protect them, and the US government will offer insurance coverage to ship owners that they cannot get at present because rates have spiked up because of this conflict. As for the inflation aspects of this, there's a fear, the bond markets perversely have been selling off as well as equity markets. And the bond markets are thinking, oh, higher energy prices, that means inflation, that means central banks won't cut anymore and they may tighten. I'm not sure it means they won't cut anymore, and I'm definitely certain they are not going to tighten. They often, almost always look through energy shocks as a transitory event. Unless we felt that oil was going to ratchet to $100 a barrel and stay there for a couple of years, I wouldn't see central banks responding to this with rate hikes. So I don't think we need to fear central banks coming in and making the situation worse. Fortunately, I think the Libero portfolios, we were heavily invested in defense names. We were invested in raw materials and commodities. We had a little bit of energy, not as much in hindsight as perhaps we would like. And we had, I think, selectively smart positioning in the AI space. And I don't really see any of this dramatically challenged by a higher oil price and by what's happening in Iran. Of course, this is an incredibly fluid situation. You cannot predict what's going to happen in a war. And so we are monitoring things as best and as closely as we can. And if we felt it was necessary to dramatically change the positioning in the portfolio, rest assured that we would do that.
So Jeff has talked about February and the more recent events. February was actually a really good month for portfolios, with Dynamic and Solutions both up over 2%. And it's interesting because they're both helped by, one, the stock performance inside the portfolios, but also Solutions was aided by the fixed interest exposure. We've been very defensive in terms of our exposure to the bond markets by staying at the very short end of the market. And again, this has been very helpful to us in terms of how the portfolio has reacted. We've reduced our big tech exposure in the portfolio last year with the sale of Microsoft, which may have come as a surprise to many people. But again, so far that's proven to be the right thing to do. We've maintained our exposure more towards the chip makers, and we've kept a position in Alphabet, again, a now chip provider, and a very small position in Meta. These are the two companies we think in the big seven are present in the key position going forward. We've really focused on owning chip providers, so like Qualcomm, Infineon, TSMC and Samsung, as I mentioned previously. We've avoided Nvidia because of valuation issues, and in reality, the TSMC and Samsung positions have actually outperformed Nvidia over the past year and year to date in 2026. So we've made the right decision to be in the right places. We're happy with that. We're basically buying the picks and shovels for AI. How the valuations return to the big mega cap spenders in terms of revenue, we've yet to really see any huge inflows of cash from that. But I think it's something we can safely say that AI is very much here to stay, and we think we're in the right place to play that. Gold and our exposure to the mining companies, both the copper and gold miners, really helped us in terms of performance in February as well. And these holdings will, we believe, still be very positive for us going forward during this period of volatility. Defence spending is unlikely to decrease, and if anything, the events over the last weekend have shown some of the constraints that some of the Western powers have in terms of their ability to put aircraft or ships into action to protect their interests. We are on the case day in, day out. If we believe we should be switching the positions to make them more defensive or to take advantage of weakness in the markets we see, then we will be doing that for you. If you have any questions, obviously come back to us directly. Happy to talk to you. Speak to you next month.